Good morning. Welcome to Stock Market Today. It's Monday, March 8th, 2021. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider upon further research. Hits your inbox every trading day before the market opens. So U.S. equities finished higher in Friday's trading, ending near the best levels of the day. Energy, once again, the standout, and was up over 10% on the week. Comm services, industrials, and materials also outperformed on the day. Lagging the broader tape was discretionary, but still finished higher on the day. All sectors were higher on the day on Friday. Treasuries were mixed. The dollar was stronger and up over 1% on the week. I think the dollar is kind of the stealth wild card out there. Not as stealth as people are starting to write about it, talk about it, and look at it. But I think the dollar is kind of interesting because it was the consensus short trade into the year. Really, the only people who were bullish dollar were the people who had been bullish the entire way down since March. It was very much a consensus short, and it pretty much stopped going down with the turn of the calendar. So an interesting development in the dollar that I think we want to be focused on here in the near term. Gold finished down 10 basis points on the day. Crude oil up 3.5%, up more than 7% on the week, and trading higher this morning with some tensions in the Middle East, if you will. So we get to the desk this morning. S&P futures are down 60 basis points. That is on the heels of Asian equities selling off overnight, with China down over 2%. European equities are seeing good gains. Treasuries are extending their recent pullback, with the 10-year yield back to about the 1.6% level, and the curve continuing to bear steepen. The dollar is bid on the major crosses. Gold down 60 bips. Crude oil is up 10 basis points. A little bit of a muted response to what's happening in the Middle East right now, but something to be mindful of as we roll into a new week of trading that starts off with us still at an inflection point. Now, I think Friday's action was interesting. Definitely had a little bit of a near-term capitulation type feel in the morning on Friday before giving way to a rally throughout the afternoon. Now, what's interesting to me is, once again, that 300 level on the Qs that I think this is the spot. I think this is where everybody's watching. And as we connect the dots and build the mosaic around everything else that I'm focused on, what I would say is we're still at an inflection point. 370 to 380 on the SPY near term, then 340 below that. That's unchanged. The Qs have already taken out near-term support, and the Qs are already back at that important level, that 300 level that we need to see hold if you're bullish. IWM support 200, 210, then 160, 170. IWM kind of less of a problem child, if you will, right now. The trend is wavering, but not broken. I think that's an unchanged view since Friday. But let's connect the dots. Remember the chart of Treasuries we showed on Friday, IEF pulling back to key support. Okay, great. We've got equities pulling back to key support, now at an inflection point. Okay, great. We have the dollar rallying into resistance. We'll look at the dollar index a little bit later on here. Okay, great. What does that all mean? That means we're watching closely, because how these inflection points resolve will tell us what roadmap we're using next. If those support levels break, if the dollar continues to rally, if treasuries continue to weaken, you're probably thinking about a more bearish roadmap. However, if the dollar begins to fade from current levels, if these support levels, especially 300 on the Qs, hold, if we get some stabilization in rates to the upside, treasury bonds to the downside, then the bullish playbook comes out, right? And that's the roadmap you're using. So right now, what I'm saying is the trend is wavering, not broken. Let's take a look at our market in a minute. What are we writing about? Well, stocks rebound from key support levels on Friday. That is true. That happened. Crude oil continues to rally, and we've got news of Middle East tensions today. Treasuries hold important support levels. Go back to the show from Friday. We highlighted IEF, the key support level. I'm not going to bash it. I'm not going to beat that horse here again. Today, we saw it twice last week. Taking a look at the commodities now. New 52-week high. Take a look at DBC continuing to grind higher, and futures point to a lower open today as the equity uptrend is wavering. So let's take a look at the major indices now from a power bar perspective. And so here's your rebound on Friday, and it was a solid day. It really was across the board a solid day. And what's interesting about the solid day is how weak we were in the morning. I mean, the NAS rebound is substantial on the day. All of them are substantial on the day. Take a look at the hammer. If we go back to this chart, look at the hammer pattern here on the SPY. But Dow adds 1.8%, 10 to 5 bulls to bears. S&P up a like amount, 145 to 49 bulls to bears there. Interestingly, the NAS was your underperformer on the day, right? So again, even in an up tape, that thematic is still playing out of your high multiple mega cap growth stocks lagging, even in up day. Up 1.5% is a great day for the NAS, especially how it started. But I mean, there's no two ways about it. It's 31 basis points of underperformance to the SPY. Small caps, better rebound, up over 2%, 750 to 251 bulls to bears there. Bonds upticked. Energy, your best group. And then I don't know what more to say. At this point, the energy trend is in motion. Up nearly 4%, 3.75% on Friday, 9 bulls, 0 bears in the energy complex, that being XLE. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain bullish. Let's hit our stock of the day. So this was kind of interesting to me, as it's an energy name that could be making the turn here. This is International Seaway, INSW, with a bullish rating, strong trend above our rising long-term trend line. Strong industry group, oil and gas, consumable fuels. At this point, we know the story in energy. So here's the trend line. Nice downtrend, go into a consolidation and beginning to work top side. Now it is choppy, in fairness, but I'm interested in this. I'm interested in the new relative strength. I'm interested in a bullish stock that's beginning to outperform, that's oversold with bullish money flow, that hasn't run away from us yet. And I think there's a few ways to think about stocks like this. I always like to say, while everybody's different, I always get a lot of the questions I get in the conversations that I have with investors, or people feel like they have to act all at once. They find a name and they feel like they have to put their size on, whatever their size is. They've determined they want to have a 2% position, a 5% position, a $10,000 position. However people think about it, I think of it in terms, percentage of my portfolio. And then my conviction levels drive that percentage for an idea. But the thing to keep in mind is you don't have to put your whole size on in one shot. And I think this INSW is interesting in that we're oversold, but still in this kind of choppy consolidation. So if you like the story, if you think this makes sense, if you think it's a fit, I mean, the way I'm eyeing this is this is a great spot to add, to build, to get a starter in the portfolio. But then watch this consolidation, watch these levels. As these levels break, that gives you to the upside, ideally, obviously. That gives you more conviction to add until you build to your full size. That's how I think about ideas that are potentially making the turn. And that's one way to think about it and a way to look at it. But this is an interesting looking name here in the near term today. As we look at our sector tracker now, moving to the major sectors over the last 5 days of trading, there's energy. There's energy up over 10% on the week. Fins and industrials round out the top three, giving us a solid look at cyclical rotation. And you've heard it before on this show, table pounding. If you're still 100% tech discretionary growth stocks in your portfolio at this time, and you've been watching my show and following along, I think that there's probably a lesson. Maybe it makes sense to go back over the past 3 to 6 months of trading and kind of see what the lesson is there, because the signs have been there for you to not be a 100% growth tech discretionary investor. They've been there. And if you're still in that group, to me, I think there's a learning experience. There's something to learn there, because these trends have been unfolding over months. It didn't just happen overnight and catch people off guard. It happened. It's happened slowly, and there's been opportunity to adjust portfolios. Middle of the road materials, use staples. Don't like seeing those defensive groups up there. Tech, REITs, and discretionary towards the bottom of the list and lagging over the past 5 days of trading. Let's hit our industry in focus. Healthcare equipment and services. Past 6 months been an outperformer, but we do have a weak ratio here at 27 to 12 bears to bulls. Number 17 of 21 subsectors. BioLife Solutions, BLFS, is very bearish. Mesa Labs, MLAB, very bearish. And Cryoport, CYRX, also very bearish. All three are holdings of a fund that is breaking down here potentially. Not potentially, it's happening. It's breaking down. Whether it continues to break down is another story. But we have a neutral rating here. Weak trend closing 2 days in a row now below the long-term trend line. Money flow has turned punk, i.e. bearish. Now, we are oversold in the near term, but I mean, you can, I guess for you pattern folks, we can play the head, shoulders, knees, and toes game as we have a shoulder, a head, a shoulder, although I do not have volume data here. But stands to reason that volume has been expanding with the breakdown. That's why Chaikin money flow is bearish. Now, relative strength also waning here in the near term. So that's kind of an interesting development as well. Let's move into what's trending now as we get a little behind on time. Not a lot of news here. Left side of the board is all oil related, nothing company specific. Paycom caught an upgrade at Jefferies. Loser side of the board, Norwegian did an offering. Enphase pressured with clean tech. I'm not going to go through the rest. You can see it, see what moved. There's not a lot of company specific news here in Friday's trading. Let's dive into the charts now. Here's crude punching back up. Remember crude went negative last April, May? Crude went negative. The price of crude oil was negative. The cost to store it was more than the cost of the asset itself. Price went negative. Subsequent to that, we've had a rally. Now, I had been in the camp that once we got above 42, we were going to 60. We went there quickly. Now I see kind of this congestion zone between 60 and 70. I think you look at pullbacks to the 55, 60 area as potential spot to get involved. Now, what I will say is Brent is trading higher this morning. Brent, this is WTI, right? This is the U.S. metric. Brent is trading closer to $70. Now, we are overbought here in the near term with solid momentum based on RSI. And look at the energy complex making the turn. See what I'm talking about here? This is not new. We didn't wake up last week and say, wow, energy is going to start leading. Like, this has been happening. We've been talking about it. The trade has been there. It's been there to be had. Hopefully you took some. Commodities in general, 52-week high, though trading into a resistance zone from the 2018 congestion. Overbought here in the near term, but again, I think that commodities is one of those things that's been playing out over time. So hopefully you have your commodity exposure. Take a look at DBC at the bottom relative to SPY making the turn. So hopefully you have your commodity exposure, right? Okay, so you're overbought into resistance. You say to yourself, I'm not going to add. I'm going to make sure my risk management process is in place. This is a conversation. This is like the thought process for me. Like, these are the conversations I have. I'm like, oh, this commodity trade's been playing out for a little while. I've slowly rotated a portion of the portfolio into commodity themed ideas. Commodities overbought and into resistance right now, but still a solid trend. Let's just watch this. Let's make sure our risk management process is in place. And watch how this plays out. Maybe it's just a stall before legging higher. Maybe it's top. Who knows? I don't know. That's the whole point of a risk management process is we don't know, right? Having a risk management process, I always say this, is your admission that you're human and that you as of now, don't have the ability to see the future. Because of that, you can do all the analysis you want. The market may still work against you. And so you have your risk management process, and as an admission that you may be wrong, you've made the decision ahead of time. And when the time comes to act, you act. I still have some growth ideas on, but I've been taking stops for 2 weeks. Just getting stopped out. Wrong. Trend no longer working. And then there's the dollar trading into resistance here. I think this is the one to watch. If you watch UUP, the level to watch is $25. This is the Dixie, the index. The level to watch is about 92. Traded into it and started to fade. But if we get further strength here in the dollar, I would expect to see the risk assets break the key levels. And if we're going to get a stabilization in risk assets, I would expect to start to see the dollar fading from current resistance zones. which for the Dixie is kind of 92 up to that declining 200-day moving average. So welcome back from the weekend, folks. Let's start the week off right.